Hey everyone, welcome to another weekly review. And what a crazy fucking week we had. Started the week off with that very strange drop, which looking back onto it now, uh, also had a spike in yields. I think it was caused by some end of month, beginning of month flows or something shenanigans. I don't know exactly what it was, but it happened right at month turn and it was a fake out. So it was a pretty strange setup going into that. And we ended the week with the jobs data, which initially was very bullish for equities. We had a move up, but then had a strong, this candle here. Then we had a strong reversal and recovered a bit afterwards. I'll get to that, to what to expect next week in a few minutes. Things to note: we have a breakdown in yields. 2-year is exactly at the Iron Dome level. If we get a breakdown here, it's a week of distribution breakdown. Target will be 2%. Also have the 20-year, sorry, going below this 475-ish level. And we look at TLT, a clear breakout from the trend line. I think due to the way data comes in next week, and we have first the annual revision for payrolls, which last year was minus 818k. This year is expected to be like between 5 and 800k. Last year it was 800 to 1.1 million, and it came in the lower end. Expectation that it will come in the lower end as well this year, so we're probably like 500 to 600k, somewhere in that range. It will be, and because that comes before the inflation prints, which we have PPI first this month on Wednesday, and then CPI on Thursday. Because the jobs data come before the print, any kind of negative number is going to make yields continue higher. So my expectation is that we'll see at a minimum 90 for TLT, or not at minimum. Basically, the baseline is 90, this 80, 89.5, 90 area for TLT. If you're long bonds, you can use this to, or long TLT, you can use this to get out. And then we have PPI and CPI. My expectation is that the print is going to be hot, and all of this craziness will get reversed, and we had a fake out up, sorry, a fake out down. Now we have a fake out up, and we will potentially go for a counter move from this fake out in the other way, and maybe go like to 82, 83 for TLT. We'll see how it plays out. There is also the case in which inflation has not increased that much or comes in soft, case in which we may even see going back to like this 94, maybe even higher, because this is a very contracted. We haven't gone into expansion yet, but we are very contracted on TLT, and it's a big move the other way. Like it should have momentum to go a long way if inflation cooperates, and I don't think it will. DXI had a move down, but still no new lows. Relatively constructive. I don't know. This should go once the jobs data comes in. This should go lower, but we are still, according to GDP now, we are still at 3% growth. Employment isn't really showing any scary signs, and the key here is continuous claims and initial claims. Unless we get a spike in initial claims that will eventually translate into continuous claims, what we are seeing now is basically a slowdown from tariffs, but it's benign. It's not something to worry that much about, especially when growth is going at 3% on a quarterly basis. So actually, when you look here on the latest USCGC, which is continuous claims, we went down last month. So this is quite unusual. Like we're seeing unemployment go up, which is okay, but numbers are not worrying. We're just at 4.3. We can go to even as high as 5, and it will still be normalization to the longer term trend. Like it's not normal to have inflation this low. I posted on Twitter, EU unemployment is at 6.2, and it's pretty fine. China is like 7 point something. Like all developed countries have relatively high unemployment, and what is considered to be regular unemployment is something around 5. Anything below 5 is very low. And US is still at 4.3. There is room to go up. There is no reason to cut in this cycle because it will fuel inflation. And uh, if this is what happens, I expect DXY to completely break down. Like we will do a new leg down because we will have easing into a hot economy, into increasing inflation, and the only thing that makes sense in this environment is basically currency devaluation. And DXY will take the cue and we will have another leg down. Uh, yeah, that's kind of the setup. Now, looking at some other stuff, we have crypto, BTC. Let's turn the ribbon on. Tried to go up, rejected by the ribbon. This is still going according to plan, let's say. Sorry, turning the Bollinger Band on. We see they're starting to contract. So while not imminent, I would expect this to get tighter. So basically we will do this. This will probably do this. And we will come to a range here and eventually the either go up or go down. If we get the inflation path, basically the one where the dollar devalues, I expect Bitcoin to actually go up. Or maybe we get a brief breakdown and we go to 100K to like do a full correction. And then it should go up and make new highs because devaluation is good for commodities, is good for Bitcoin, is good for hard assets in general. ETH kind of the same thing, is still contracting, but the bands are still really high. Same thing in the idea that the ribbon is becoming resistance, and this should eventually lead to a push down. It doesn't necessarily have to go all the way here, but we should go at least briefly below the 55 EMA here at 4900. So at the minimum, a tag below 4K to like 36, 38, and then a bounce and go higher. And coming to equities, I'll show on US 500 first because it looks like this. Uh, we Bollinger Band's very contracted. Try to go higher, but respecting this trend line here and getting rejected multiple times. We should continue seeing it bounce up and down in this area because we're on SPY. Let's turn this to the daily. Oops. Okay, so first drop, expectations that we would go to the 21 EMA. We overshot a bit, but bounced from the 21 EMA. Next top, expectation was that we would go to the 44 EMA, and this is what we did. And another bounce, another high. But the highs are getting uh, more difficult to make. Like every time the new high is only slightly higher before finding sellers and going lower. Now, expectation is that we will go to the 55 EMA, so we will break down below this level. And this, in theory, should be the cue for a larger breakdown that eventually pushes us to 620 here, but 620 should be the end of leg one of the breakdown. So uh, some consolidation here, maybe go to the 21, maybe go back higher a bit. Uh, so wait, we have Tuesday, this is the jobs data. So maybe something like this. Bounce on the jobs data, go back here. But we haven't made a lower high, so we made a higher high again. We actually need to see a higher high. And while this isn't according to the thesis, it is still a standard UTAD, a fake out of making new highs, getting immediately rejected, which is good for the bearish case. So what we of distribution, you want to see the image, man. Copy image. Like this because it's too high, too big. Still too large. It worked. So this is the starting point, and we go higher. Let's try to overlap it, something like this. It's difficult. Point is, we are here. This was here. Then this high here was this. Then this high here is the UTAD. And what should we be seeing for moving forward is that we make a lower high. So now this has to become the point of no bullish moves. So I would expect maybe we go back to, because it's very a brief move, we go back to the 21 EMA, we bounce on the 21 EMA, then due to the jobs data confirming the cuts, we go back to like 650 and get rejected without making a new high, and then it's basically all over. We can take this as the cue that things will start going down. Then we have PPI somewhere. Let's put PPI as well. PPI is here. So let's redraw. And we stay at the highs, and then PPI comes in very hot again, and we dump. Then we try to go stabilize here, and we dump again from CPI, and then we break down. We go here, we backtest it, we bounce from here, we backtested the breakdown point, and then we go to 620. 620, and this is where we find support because this should be like a very more like a single move. Obviously there will be some short-term bounces, but as a single move, I mean we will follow the ribbon. We will not go above the ribbon. Then this is leg one. We bounce, we get rejected again, and then we should do another leg down to like the 600 area, and that should be about it. And yeah, that's kind of it. Then we start going higher again to new highs because the cutting cycle will start kicking in, and whatnot. The market starts beginning to price inflation. Okay, so this is kind of the take. Basically, go down and bounce to whatever. We can actually even go higher. Jobs data should not get us above 650. Then PPI, CPI, double hammer. We break down, uh, and then we go to 620, a larger bounce at 620, and finally the big move to 600, the 600 area. And here we have way too much support to to go below it right now. Maybe a bit of an overshoot, but I kind of doubt it. And then the final leg of the theoretically bull market, and the final leg was to like 6,700. It could be higher as well. We shall see. But this is kind of my expectation. We're getting to the end game of this distribution at the top, and next week, it should be when it actually plays out. But we have to wait and see what the inflation expectations are. If the inflation print is okay to the market's liking, I think we can go even higher and continue basically the pattern of slightly higher highs. Basically, what this is, let's say PPI is hot, and then we bounce here, and once again we go higher, like 654. But the inevitability of a breakdown or a larger correction is the higher we go, the bigger the chance. Like we have gone up way too much without a pause. Uh, it's not like if we don't go down, we go up. No, it's we only go down briefly, go up briefly every time, and the chances of having a breakdown that takes us to 600 gets higher and higher every time we make a new marginal high. This is how you should be looking into it. So yeah, that's it for this week. Have a good one. Bye bye.